Good morning. I'm Tom Belding of Belding Financial Planning based in Chatham, New Jersey. I am a fee-only fiduciary offering financial planning and investment advisory services. Today we have a seminar on Secure Act 2.0. I'd like to share some slides with you. Before we get started, I'd like to thank Sage Elder Care in Summit, New Jersey for helping to sponsor this program. The new retirement rules understanding Secure Act 2.0, key insights for your retirement planning. Here's our challenge. Secure Act 2.0 has passed in December of 2022, making it the most significant piece of retirement legislation since the original Secure Act was passed at the end of 2019, with a total of roughly 100 provisions, mostly around retirement plans. We need to first get our arms around the key changes and assess the implications. The good news is that there are numerous benefits to investors related to more time to save, more ways to save, and more ways to use those funds. The challenge is simply absorbing the breadth of the change. Most of these provisions are effective this year, 2023 and 2024, but others are pushed out to 2028. Today, we're going to place our findings under one big umbrella and highlight key changes that you should know about. But before we dig in, everyone's tax situation is different. You should always consult a qualified tax professional to discuss your specific tax situation. I am a financial advisor and I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and investments, and then develop a plan for retirement that takes those taxes into account. So what's the impact? Today we'll cover highlights of what we call Secure Act. That is actually parts 1.0 and 2.0. The first was passed, as I mentioned, in December 2019. Then the second version just this past December. The impact is far-reaching, from the silent generation to boomers who are thinking about estate plans, to boomers and Gen Xers focused on retirement, to millennials and Gen Zers who will be the recipients of a great wealth transfer in coming generations. As we all well know, taxes are complicated and impact your savings, investments, and retirement plans. Generally, the new rules are actually very saving friendly. However, they require that everyone reevaluate their financial plans in order to capture the opportunities they present. In addition, the government sees businesses as the conduit to help expand and promote retirement savings by their employees. I want to make sure you understand how the changes will impact you, your family, and if relevant, your business. So what parts of the Secure Act will specifically impact me and my plans for retirement? That brings us to our first key slide. The new provisions of the Secure Act give you more time to save for retirement, but you need to know how those provisions work so you can take advantage of them. The Secure Act is giving you more time to save for retirement and provide greater opportunities to save and reduce taxes. So what does more time to save mean? There are a number of positive changes to age limits, some allowing you to contribute longer to your plan, and others allowing you to hold off on taking mandatory withdrawals from your retirement accounts. The next slide will give us a closer look. New rules for the required minimum distributions. In the past, savers were forced to withdraw money from their IRAs starting at age 70 and a half, whether they wanted to or not. Those withdrawals are called required minimum distributions, or RMDs. The Secure Act has now increased the age you start taking those forced distributions all the way to age 75, depending on your current age. As you see on our table, anyone currently subject to and taking RMDs must continue their existing schedule. So if you were born before 1951 and turned 72 in 2022, you should still be taking your first RMD by April 1 of 2023. If you were born in 1951 to 1959 and turned 72 this year, your required withdrawals start next year when you turn 73. Note the star on the table next to the year 1959. This indicates that we've confirmed that there is a mistake in the law that would have those folks starting their RMDs at both age 73 and 75. This will ultimately be corrected, but for now, we're keeping it on this table at 73. Those born in 1960 and later will not start taking RMDs until age 75. This gives your money more time to potentially grow tax-free. Remember, however, building up large IRAs means larger RMDs in the future. This can have tax consequences when it comes time to start drawing down your retirement assets. Examples are potentially higher Medicare IRMA surcharges, higher tax brackets, and possibly higher tax rates moving into the future. Note that the Tax Cuts and Jobs Act of 2017 expires in 2025. This may result in substantially higher taxes in future years. This is a topic we can discuss one-on-one if you'd like. In the past, failure to take a prescribed RMD resulted in a 50% penalty. This has been reduced to 25% with a 3-year look-back, and further reduced to only 10% if you correct the error in a timely fashion. Lastly, the new law eliminates RMDs for 401ks, 403bs, and 457b accounts. So this now matches the rule for Roth IRAs, that is, that there will be no RMDs. It still makes sense to consider rolling assets from a company plan into a Roth IRA for broader investment options or potentially lower fees. This is all good news. Surviving spouses can now adopt their deceased younger spouse's RMD schedule. The primary benefit of this new rule would be to older surviving spouses, who can now assume a deferred RMD start time. The benefit is that if the older and surviving spouse doesn't currently need the money, they can delay withdrawals, allowing potential for the account to grow. Another benefit is that the RMDs would also be smaller than if the surviving spouse treated the retirement account as their own. Remember, RMD percentages increase with age. If the surviving spouse passes away before RMDs begin, the new 10-year RMD disbursement rule does not apply, meaning any eligible designated beneficiary could stretch the payouts over their life expectancy. I'll define eligible designated beneficiaries in a later slide. Previously, you could only contribute to your IRA until age 70 and a half, and then you'd be forced to start withdrawing RMDs. The new legislation gives those wishing to work longer more opportunity to save and the potential to create a larger nest egg when they finally retire. Enhanced catch-up contributions. First, in 2024, catch-ups will begin to be adjusted for inflation. Second, starting in 2025, a special enhanced contribution has been created for those aged 60 to 63 of $10,000 or 150% of the regular catch-up amount for 401ks and 403bs. And for simple plans, it'll be $5,000 or 150% of the regular catch-up amount. This table frames the catch-up contribution changes by age. For those 49 or younger, catch-up is not available. Standard catch-ups for those age 50 to 59 and 64 and older are increased to $7,500 in 2023. Special treatment for those 60 to 63 is $10,000 or 150% of the standard in 2024. The bottom line is that the rule changes allow for participants in IRAs, 401ks, 403bs, and simple plans to contribute more to their plans. So if you can keep setting money aside each year, that's great news. You'll defer your taxes and grow more savings for your retirement years. If you're thinking these new rules make me wonder if I should consider putting more money aside for my retirement, it's a good thought because that's what the Secure Act rules help people do, including Roth plans at work, auto enrollment, and help for part-time workers, young families, and professionals. Let's take a look. Aside from more time to save, the Secure Act now provides more options for your to invest for your retirement. The following slides address changes to workplace retirement plans. There are significant changes to Roths, both for personal retirement IRAs and in employer-sponsored retirement plans. Starting in 2023, the addition of employer matching contributions to the Roth side of the plan is a great opportunity to build assets that will escape taxation when withdrawals begin. Employer matches were formerly restricted to just the tax-deferred bucket, meaning employees could have a larger future tax obligation. It's important to note it is not mandatory or automatic for employers. Matching after-tax contributions to company Roth plans is entirely at the employer's discretion. For employees making more than $145,000 annually, Your only option is to make catch-up contributions to a Roth account. The only exception is if the company plan does not offer a Roth option. And it's worth mentioning again, RMDs will be eliminated for Roth 401ks, 403bs, and 457b accounts starting in 2024. It will no longer be necessary to roll 401k or Roth 403b funds into a Roth IRA simply to avoid taking RMDs, though other factors might still make that a worthwhile consideration. Auto enrollment boosts how much you can save to 15%. Starting in 2025, to encourage and increase retirement savings, your employer is required to auto-enroll you in their 401k or 403b plan. Then you'll have the chance to opt out if you like. In year one, your employer will determine how much of your salary they can allow you to put aside for savings. It will be between 3% and 10%. In years 2 and thereafter, that number will increase to between 3% and 15%. In addition, that number will auto-escalate by 1% annually. Those new to the workforce or changing jobs in 2025 stand to gain the most. Studies have shown that auto-enrollment increases 401k balances, so Congress wants to continue the good work. But we all know the earlier we start, the greater potential to create more money for when we retire. This might be a good time to look at your own 401k and consider if you're saving enough. Is that the right place to put your retirement savings? How much is your employer match? So forth. Some business types are exempted from the auto enrollment requirement. This is something we can discuss one-on-one if it applies to you. Companies can now offer annuities inside their 401k plans. Annuities can play a role in retirement income planning by turning a portion of savings into a stream of income, helping address the question of, will I live to an advanced age and possibly run out of money? 401k plans for small businesses. The new legislation is casting a wide net and providing small businesses another way to attract, retain, and help their employees save for retirement. The starter 401k is a new option, though unlike regular 401k and 403b plans, employers are not required to match your contribution, and contributions are lower. It is, however, a path to help boost retirement savings. Next, we have some good news for part-time workers who also want to save for retirement. Employers with a 401k plan must allow employees to contribute to the plan once they have worked at least 500 hours for 3 consecutive years or 1,000 hours throughout the year. This is especially good for some women who may work part-time for caregiving reasons and often have less saved for retirement. Heads up, if you're a part-time employee, check with your employer about when your 500 hours start and end. It may not be as clear as a calendar year. SEP and Simple plans get Roth options. For 2023, the Secure Act adds 2 new options for Roth contributions to Simple and SEP IRA plans. Although it won't be required for employers to put this in place, it's there if you want to take advantage of it. Also effective in 2023, you can offer your household employees, such as a nanny or a cleaning person, a SEP IRA plan. It's a nice benefit depending on your financial circumstances. Simple and SEP Roth plans are straightforward ways for small businesses with 50 or fewer employees to contribute toward employee savings, and yours if you're the business owner. Previously, Simple and SEP plans only allowed for pre-tax funds, which are taxed when you take the withdrawal. Additional employer contributions will be allowed for Simple IRA plans in 2024. These will be capped at $5,000 per employee, in addition to the required matching, or 2% of pay. Once again, there may still be good reasons to roll Simple or SEP assets to a Roth IRA. The availability of investment options, fees, and services should be a consideration. This law was passed in late 2022, so it will take some time for participating employers to set up their systems and procedures in alignment with the IRS rules. Help building emergency savings. Since many Americans don't have rainy day funds, emergency expense distributions from a retirement account can provide a way of accessing some money for unexpected expenses. And you get to do so by using your retirement plan. This will be effective in 2024. While it's only offering $1,000 annually, The definition of what qualifies as an emergency withdrawal is broad and seems to account for many circumstances. These rules are especially beneficial for new families or young professionals. Highly compensated individuals are not eligible, and money must be held in cash or equivalents, and participants must have monthly access to the funds. Student loan help from employers. There is a new student loan repayment match where employers can help employees who are paying off student loans. An employer can make a matching contribution on behalf of the employee into their 401k, 403b, 457, or simple IRA with respect to qualified student loan repayments. This will be available to employers in 2024. In addition, graduate and postdoctoral students can start contributing to an IRA with an expanded definition of earned income. Stipends and non-tuition fellowship payments to graduates and postdoc students count as earned income, and that means these students can contribute to IRAs. This is good news for students who want to begin accumulating tax-favored retirement savings. In many cases, graduate study keeps them too busy for a job that might offer a 401k or other savings benefit. Lifetime income estimate for your 401k. This new disclosure will show how your total savings may translate into monthly income. This can really help with discussions about your retirement, especially the future cash flow and income you'll need. Now you may be saying, I see how I'll have more time to save now. Can the new rules help me in other ways? The short answer is yes. The new legislation has made sweeping changes for how you can use your money, from 529 conversions to funding long-term care. Let's explore a few of the more prominent changes that you'll need to know about or that have broad implication for investors. The Secure Act provides new ways to use your money. We all want to feel smart and responsible about how we handle our money. Now I'm going to share some parts of the Secure Act that will give you some new ways to use your savings. We all want to feel smart and responsible about how we handle our money. Now I'm going to share some parts of the Secure Act that will give you some new ways to use your savings. You'll have a new option for making charitable donations more tax efficiently. You're also going to be able to maximize the benefit of college savings accounts or 529 plans in new and interesting ways. Finally, there are some new reasons you can take money from your retirement account if you need to, without paying an early withdrawal penalty. You may be familiar with qualified charitable distributions, or QCDs, and if you're not, QCDs were introduced in 2006 to help people age 70 and a half satisfy their required minimum distribution, or RMD, by making charitable gifts with the money in their IRA account. If certain rules are met, they can directly transfer up to $100,000 annually from their IRA to a qualified charity of their choice. And again, that donation would satisfy all or part of their RMD requirement for that year. Effective in 2024, the new law maintains the maximum transfer at $100,000, but this will be adjusted for inflation each year. Now, it's important to note that it must be a qualified charity that you're donating to. It's best to check with your tax advisor, because there are some organizations like private foundations that are ineligible for donations under this law. Also, beginning in 2023, the new QCD law applies for a one-time only ability to fund what's called a split interest entity for up to $50,000. This could be certain types of special need trusts, for example. It gets a little technical, so if anyone would like to discuss this one-on-one, I'm happy to set up a follow-up. The use of 529 accounts to pay off student loans. This rule change allows you to use money originally set aside for your kids' or grandkids' education, possibly avoiding the need to dip into savings earmarked for retirement. Investors who have a 529 education savings plan can now withdraw up to $10,000 to repay student loans. We all know that student loan debt is a crisis in America. This new provision is one way that savers may find relief, allowing them to put less money towards student debt and more toward retirement savings. A related change is that 529 plan monies can now also be used for apprenticeship programs, provided they're registered with the Department of Labor. Some kids don't go to college but still need money to prepare themselves for the workplace. Now they can use the 529 plans their families may have already funded. And in case you didn't know or had forgotten, since 2017, a $10,000 per year 529 plan withdrawal has been allowed to cover private K-12 education, broadening the use of these plans. Do you have or anticipate having money left over in a child's 529 plan? This new rule could make it easier to save for your child's college and jumpstart their retirement savings. Here are the details. Excess funds in a 529 plan can be rolled over directly into a Roth IRA for your child, the beneficiary. Beneficiary must have earned income. You will not be taxed on the transfer of the funds, and the money will continue to grow tax-free. Beginning in 2024, you can roll over up to $35,000, that's a total lifetime maximum, from a 529 plan to your child's Roth IRA. Annual transfers are also subject to annual Roth IRA contribution limits, currently $6,500. Another benefit of this rule is that there are no income limits for participants, meaning that while high wage earners usually make too much money to contribute to a Roth, they will now be eligible to do so for their kids or grandkids with leftover 529 money. There are some strings attached. First, the 529 plan must have been in place for 15 years before it is eligible for a rollover to a Roth IRA. Secondly, money added during the last 5 years cannot be used. If you max out the 529 transfer for the year, $6,500, the beneficiary, child or grandchild, can't add funds from other sources. You're capped at the annual limit for Roth IRAs. The bottom line is that we now have some flexibility when we have excess funds in 529 plans. You can keep all the funds in the 529 without penalty, and your child can use the money for their children, and/or you can transfer funds to jumpstart your child's retirement. The best solution depends on your unique situation. Penalty-free withdrawals to fund long-term care insurance. Several new items have been added to the list of penalty-free withdrawals you're allowed to make from your qualified retirement account before age 59 and a half. Paying for long-term care insurance is now one of them. This is a tremendous benefit for a few reasons. As we age, more and more of us will encounter a major health event that requires long-term care, such as in-home medical assistance or a nursing facility. The high cost of care for an unplanned critical illness or health crisis can be catastrophic for families, and unfortunately, Medicare doesn't cover much. The average cost of a private room in a nursing facility can be $100,000 or more, depending on where you live. Many people forego long-term care insurance because they think it's too expensive, but as you can see, so is the cost of care if you're caught by surprise. The new rules make it more affordable and tax-friendly. Clarity is needed from the IRS about the type of long-term care insurance that qualifies under this rule. The law is vague and only calls it, quote, high-quality long-term care insurance. If you have health issues or a family health history that concerns you about your future, let's set some time to discuss it. Penalty-free IRA withdrawals for new parents. In case you missed it or forgot about it, this rule has been in place actually since 2019. New parents may each withdraw up to $5,000 penalty-free from a retirement account for a qualified birth or adoption. To meet the requirement, the individual must take a distribution from their retirement account within 1 year of either the date of birth or the date on which the adoption of an individual under the age of 18 is finalized. Even though there will be no penalty, you may still owe taxes on the money withdrawn, and of course, it means less savings for retirement. So be sure to talk to a financial advisor to see if withdrawing this money is a good move based on your overall financial situation. Penalty-free withdrawals for other circumstances. Several new provisions have been allowed for special circumstances, and now these early withdrawals will qualify as penalty-free. This applies for someone who is terminally ill, for victims of domestic abuse, for public safety workers, which now includes firefighters and others. There's a new provision made for expenses coming from a federally declared natural disaster. This rule is retroactive to 2021 and later, and allows for a maximum distribution of $22,000, which may be both taken and repaid over 3 years. Retirement plan loans for people living in disaster areas are increasing from $50,000 to $100,000. Undoubtedly, some of you have already saved enough for retirement. Hats off to you. Now you're starting to think about the next generation and estate planning and wondering What do we need to know about leaving our IRAs to our kids? Is that still allowed in the new rules? Our key point number 4, kids can still inherit your IRA, but they can only defer taxes for up to 10 years. Unfortunately, the news here isn't so good. This was a big rule change in 2019, and it's worth addressing again today. Not only are your retirement savings affected by these new rules, but the death of the stretch IRA requires a review of your estate planning thinking. Let's look more closely. Time limit for inherited accounts, including Roth IRAs. With certain exceptions, which we'll see in a moment, beneficiaries of IRAs, including Roth IRAs, must liquidate the accounts within 10 years. Previously, IRA owners were encouraged to have younger beneficiaries because they could stretch the distribution over the beneficiaries' lifetimes, allowing for a longer tax-free growth. Some heirs even plan to use the accounts for their own retirement. But now they must take out the money within 10 years of the death of the original owner. This could have major repercussions for the beneficiary. When they withdraw that money, they'll have to report it as income and pay taxes. This could affect the FAFSA, the student loan application form, if they have children applying for college financial aid, and possibly limit their ability to claim certain tax credits. It could affect what tax bracket the beneficiaries are in. And this may happen during a time when tax rates are also higher, keeping in mind that tax rates are presently historically quite low. There's no rule about how to draw down the account, provided it's gone within 10 years. So the beneficiary could put some aside for each of the 10 years or none for 9 years and then take everything in the 10th year. Planning is needed, and this should include consulting your accountant. If you have a large IRA balance and know it will be part of your estate, please catch up with me so we can schedule some time to talk about strategies. Exceptions to the new 10-year rule. As I said before, there are some exceptions to the 10-year rule, or what the IRS calls eligible designated beneficiaries, a term we used earlier. They include surviving spouses, disabled or chronically ill beneficiaries, beneficiaries who are not more than 10 years younger than the original owner, and minor children. In that last case, the 10-year clock starts when they reach legal adulthood and doesn't include grandchildren or other relatives of the original IRA owner. All these eligible designated beneficiaries. The stretch IRA is mostly business as usual. Also, the new rule does not apply to people who inherited an IRA prior to January 1st, 2020. What are some lessons from the death of the stretch? The real lesson in all these changes, particularly the death of the stretch IRA, is that tax planning is more important than ever. Congress is looking for ways to increase revenue, and one way to do that is to eliminate tax breaks. The real lesson from all these changes, particularly the death of the stretch, is that tax planning is more important than ever. Congress is looking for ways to increase revenues, and one way to do that is to eliminate tax breaks. We may see other changes before the time comes for you to retire and pass on your estate. For many years, even decades, people were told to rely on IRAs, and many Americans listened, to the point where, helped by a 10-year bull market, they have a lot of money invested in these tax-deferred accounts. The problem is, one day the tax bill will come due, and you can't predict what the tax law will be when it does. One thing we can say is that tax rates will more likely go up than down. According to Michael Semblist at JP Morgan Asset Management, post-World War II, given the massive spending during the war, the national debt was about $30,000 per person in the US. That's in 2023 dollars. That is now roughly $100,000 per person, 3 times as much. Despite this huge increase in the debt, federal tax rates are now less than one half what they were 40 years ago. One way or another, the accumulating tax bill will need to be paid, possibly by our children. Many of them will inherit our IRAs. As I've said, I'm not a tax professional and I don't give tax advice. All tax decisions should be reviewed by your accountant. But I can look at your investments and savings and help you plan ahead. Taxes in retirement are a much bigger issue than many of us realize. It's important to prepare a retirement income plan so that you can draw down your accounts in a tax-smart way. Some of our strategies might include Roth conversions, managing your tax brackets, reviewing your beneficiaries, including trusts, and creating an estate plan that makes the best sense for everyone in your life. Hopefully, I've conveyed some of the importance of the new retirement rules brought to you by the Secure Act. And you can see how important it is to focus on what's going to be the most impactful for your life. You're probably wondering what your next steps are. First, let's review the key points we've covered. We started our presentation by saying the Secure Act changes the retirement rules, and that means current and future retirement plans need to be reviewed and adjusted. Our first key point, the new provisions of the Secure Act give you more time to save for retirement, but you need to know how those provisions work so you can take advantage of them. Secondly, the Secure Act gives you more ways to save for retirement. Thirdly, the Secure Act gives you smart and responsible new ways to use your money. And fourth and final point, the death of the stretch IRA means that your kids can still inherit your IRA, but they can only defer taxes for up to 10 years. We covered a lot of ground here today, and I hope we can agree these new rules are sweeping and widespread, yet mostly positive. Everyone's situation is different, and there are many factors to consider. Qualified professionals can help you form a clear and effective strategy. Please reach out to me if you'd like to discuss anything further. Thank you for attending today's program.